Hi, it's Michael Martella, Senior Investment Advisor. Hoping all is well. Today I have JP Laporte, who is the CEO, pension lawyer with over 22 years of experience from INTEGRIS Pension Management Corp. He's extremely well recognized in the field, both Ontario and Quebec, and I've known JP for quite some time now. And today we wanted to discuss the benefits of a PPP during a very specific stage of an entrepreneur or a medical professional's business life, the what we call the accumulation stage of the business cycle. So, JP, thank you very much for taking the time out of your day.
Yep.
Thanks again. I want to, I guess, give maybe an introduction on very quickly on what a PPP stands for. Very high level. I mean, in a nutshell, it is a personal pension plan, which is an alternative or an alternative to, I guess, an RRSP, if you will, mainly implemented in a corporate structure by the corporation for a owner that is accumulating income via a T4. So that's the I guess you could say the 101 explanation. I've implemented many PPPs for clients and talked to countless prospects about the benefits of PPP, which we're going to get very specific today during the accumulation stage. So, JP, if I kind of missed anything on a high level of what a PPP is, please feel free. And then if you can kind of start it off with what you feel is the more important or the more glaring benefits of a PPP for a medical professional business owner during their accumulation stage of their business practice.
Yeah, for sure. So there are multiple tax deductions that are possible when you have a personal pension plan that you do not have if you use an RRSP. And these are grounded in pension legislation. So it depends which one will apply at different times. But if I were to do a laundry list, the very first one is what we call the past service buyback deduction. So this is where the medical professional, I'm going to use a doctor as an example throughout. So a doctor who's been incorporated for a number of years, been receiving T4 income, salary, or bonus, and decides to set up a PPP, that doctor can look back to the date of incorporation and pick up all the years that a salary was paid, and that forms part of what's called past service. So there's going to be a corporate contribution that's made by the medical professional corporation to the PPP in order to fund the purchase of these years of past service, and that's a corporate tax deduction. And that we've seen it go as high as about $550,000.
So basically, JP, to kind of put this in a look at it from a different angle. So basically, what you're saying is, let's say this doctor or any incorporated professional or any incorporated person, they have the right when they're looking at implementing a PPP. We go back all the way from the creation of the corporation, right?
Correct. Yep.
And basically that the individual will have the right to accumulate past service due as if they implemented the PPP from day one of incorporating.
It's a catch-up payment. It's a catch-up exercise.
Right.
That's exactly what it is. So that's the first deduction that if you're in an RRSP, you don't have. Okay. And we're talking maximum $550,000. Then the second advantage is what I call the double dip. So not only are you able to put money in your PPP in year one, you're also able to put money in your RRSP in year one.
Right.
And you can transfer those RRSPs into the PPP as well.
So just to kind of just take a one step back here, because I did mention it, but I just want to clarify to anybody who's kind of listening, so nobody's really confused. What a PPP is a pension plan that kind of replaces, if you will, an RRSP. So we do an exercise to see if the PPP makes sense. We come back with an illustration to show you what the difference is between a PPP and an RRSP, and like a table, and okay, well, if you implement a PPP, this is what happens. This is how much you're allowed to put away, and with projections and all that stuff, versus an RRSP. The PPP, once you believe or you feel that there is a benefit, and most of the time there is, but once you feel that there is a benefit, at that point in time, we're talking about these particular advantages here, JP, where we can go back to the incorporation date and take a catch-up deposit from the corporation to the PPP plan. Now, correct me if I'm wrong, but from a classification standpoint, the PPP is personal and it's funded by corporate dollars. So basically, the corporation is sending money to the individual's pensions, funding that person's, the shareholder's pension plan, the personal pension plan. Is that correct?
That is correct.
Okay, good. So we've touched on the catch-up rule. We've touched on that the first year that we implement the PPP, that the individual will be able to both get the deduction on the PPP side and the corporation, and they'll be able to do the RRSP deposit, correct?
Correct. Yeah, that's the double dip.
The double dip, right.
Yeah. The third advantage is that on an annual basis, the PPP contributions will always exceed the maximum RRSP contribution limit. So there's a delta of additional monies that are being put to work inside of a tax sheltered pension plan.
So
that's a
yeah. So basically, JP, just so I could, I mean, I'm quite familiar with this notion, but just to kind of clarify it visually for somebody, let's assume your T4 was 125,000. Okay. So on the RRSP side, you're allowed a percentage of that 125,000 up to a certain amount. Okay. The numbers are not relevant really, but what you're saying is for the same T4 amount on the PPP side, the number is higher.
Yeah, it starts at 18% and it plateaus at age 64 at about 28%.
Okay, so just for those that aren't familiar with the RRSP limits, it's capped at 18%.
Correct.
To a maximum amount. So yep. Even if your T4 is $500,000, you're capped at a certain amount, which is way below 18% to $500,000.
Yeah, it's $29,210.
Exactly. So are there any limits on the PPP, JP?
Well, there are, but they're much, much, much higher.
Right. So it's all relative, right? So,
yeah.
So someone showing a T4 of 150 on an RRSP versus a PPP, the allocation limit is going to be higher on the PPP plan.
So let me just give you a concrete example. If you're 64 years of age and this T4 that the company is paying you is $171,000 this year, you're going to be able to put $18,000 more in the PPP than you would in an RRSP.
That's significant, especially over time. So, we're talking about 1 year, a differential of 18,000. Imagine that being over 15, 20, 30, years of service, of being in business. That differential is huge because that money is growing tax exempt.
Exactly. So the fourth extra deduction that you get with a PPP that you don't get with an RRSP is what we call the special payment. So this is when it's a top-up payment made by the corporation with pre-tax dollars, just like all the other contributions. That happens when the internal rate of return inside of the pension plan is below 7.5%. So if, for example, if you took an extremely conservative approach with a client because for whatever reason they just cannot stomach any market risk, and they said, Michael, I will only hire you if you put me in GICs.
Right.
Okay, it's an extreme example.
Right.
Right. Or bonds or government bonds.
Right.
That are paying what's a government bond paying these days?
Let's say it's 3% for argument's sake.
All right, 3%. So you're in government bonds paying 3% interest inside your PPP, And of course, that's not anywhere near 7.5%. So when we look at the plan's health, we would say that it's underfunded.
Right.
It's not growing fast enough.
Right.
What the pension legislation allows us to do is to give the corporation the right to make a top-up payment called a special payment. And that's also tax deductible. And that special payment is meant to pick up what you didn't earn. Anywhere from 3% to 7.5%, the missing gain is made up with fresh money from your corporation.
So JP, just to kind of, again, looking at it from a different perspective or a different angle, what you're saying is that when someone implements a PPP plan, there is an expected, because it is, after all, considered a defined benefit, and which means that the benefit that the individual will receive in the future is defined,
Right.
in a nutshell.
Yep.
So because of that agreement, what you're saying is there is an expected rate of return, which is set between the corporation and the individual under contract of pension legislation. And this rate of return is 7.5%, you had said.
Yep. It's regulatory. Yep.
Regulatory, so 7.5%, which is fine and fair. Now, if the portfolio over 1 or 2 years, let's say, does not, or 3 or 4 years, does not meet that rate of return, what you're saying is that the corporation has an obligation, or it can.
It can. It has the ability, but not the obligation.
It has the ability, it has the ability to, but not the obligation to make up the difference.
If it wants to, if it needs more tax deductions.
Yeah, of course. So A, it has to have the cash available to do so, and B, if it wants more tax deductions.
Yeah, just as a segue into my next deduction,
Yeah.
if the corporation doesn't have the cash on hand from operation, it could borrow from, let's say, a holdco or a family trust or even a shareholder. It could borrow from a third party.
Yeah.
And then the interest that's paid back to the lender is also tax deductible for the corporation.
Right. Right. Okay.
Which you cannot do with an RRSP.
Correct. You cannot borrow money, deposit to an RRSP, and deduct the interest that you pay on the borrowing costs. You cannot do that.
It's not permitted under RRSP, but it is permitted under PPP.
Now, let me play devil's advocate here on the upside. So what happens if the portfolio continuously outperforms the 7.5 benchmark?
Great question. So we do have surplus now that starts building up inside the plan.
Yeah.
And the pension legislation distinguishes between two different types of surplus. There's what we call normal surplus, and then there's excess surplus. So normal surplus is those extra assets that are sitting inside the pension fund that are between the 7.5 and 9.375% rate of return.
Okay.
If you exceed 9.375%, which works out to a 25% surplus buffer,
yeah,
then you trip up into what's called excess surplus. Under normal surplus, there's no change. It's business as usual. You can keep making contributions. Under excess surplus, the Income Tax Act triggers a rule that says the corporation must take a contribution holiday. So while the company was getting used to all these tax deductions, now that it's not allowed to contribute, it can't claim any deductions.
Which means it can't make a deposit.
Correct.
So it make a deposit but not make a deduction, or it cannot make any deposits?
Cannot make a deposit.
Very good. So in what you're saying is for the PPP to run smoothly from a tax perspective, a deposit perspective for the corporation, and an asset accumulation from the individual, rate of return of, a limit of, let's say, 9.3 is kind of a good thing, because if okay, obviously there's possibilities, on once in a while of hitting 15-20%, whatever it might be, if the market's really bull. It's not going to happen all the time, but that just means that it's possible that we're going to have to put the pension plan on a holiday for 6 months, a year, or something like that, and then restart it the following year. So
no, Actually, Michael, sorry to
No,
be the
no,
devil
please. This is
advocate.
this is why I'm asking the question.
Yeah. So it's not an issue with a PPP. It would be if we had used an IPP, an individual pension plan, and we were in excess surplus. Then you're right, because if you like the tax deductions, they cease when you hit 9.375% and you're in excess surplus. But we're in a PPP, which is a advanced, more flexible version of the IPP. Still a registered pension plan, except that it has another account called a defined contribution account. And if the defined benefit portion of the PPP is in excess surplus, all we need to do is switch into defined contribution mode. What that does is that it freezes that formula that you were talking about. And if the formula is frozen, we're no longer generating what are called pension adjustments. It's those pension adjustments that eliminate your RSP room. Well, if we're not generating pension adjustment because we're not using that formula anymore, we can start putting money in our personal RRSP the next year.
Right.
So you're still getting tax relief at the personal level, even though the corporation has to deal with a contribution holiday.
Perfect. Completely understood and well explained. Thank you, JP.
Okay. So that was the fifth deduction.
Yep.
The sixth deduction is, the mother of all tax deductions. It's called terminal funding.
Yep.
So terminal funding is the concept by which a corporation will inject all kinds of extra money in order to allow the shareholder, the doctor, for example, to turn on the pension well before age 65. So let's take an example. Imagine that I'm a teacher and I start teaching at age 25, and now I'm approaching age 55. And I say, you know what? I've had enough of teaching. I want to retire. I need to get my pension. And I knock on the door of the teacher's pension plan and I say, I know that you would have paid me $100,000 a year annual pension, defined benefit, if I had turned on my pension at 65, but I can't wait that long. I must start at 55, 10 years sooner. So what happens? Well, the teacher's pension plan will say, no problem, you can do an early retirement, but we're only going to pay you $40,000 a year for the rest of your life. We're going to actuarially penalize you for those 10 years that you're not contributing to the plan, So yeah, you can retire, but don't expect 100 grand. We're paying you 40.
Right.
That's the normal rule. The way that terminal funding kicks in is that if you do terminal funding, what happens is this. Take again the teacher wanting to retire at 10 years sooner. They would say, okay, I want to retire at 55, but I want an enhanced early retirement pension. I want my 40,000 plus I want another $30,000 bridge pension, and I want an early retirement subsidy pension of another 10,000. So please, at age 55, give me $90,000 a year, not 100. I know I can't get 100, but I want 90. And the law allows for it. That's why you hear of these teachers retiring on a full pension when they're still young, because the law allows for this.
So basically what you're saying is that if someone who's implemented a PPP retires or sells their business or closes their practice or sells their practice before the age of 65, the corporation can pay for the years to make up. So if the individual decides to retire, sell their business, or sell their practice at the age of 60, there's 5 years of forward contribution that the corporation could make.
Michael, it's even better than that. You don't even have to sell your business or hang up your stethoscope. All you need to do is stop taking a salary from your medical corporation and ask the pension plan to turn on the pension to replace your salary. Everything else stays the same. I mean, you're still a shareholder, so you can supplement your pension with dividends. So your standard of living remains the same.
Right.
Except that now you've triggered a massive corporate tax deduction called terminal funding within your corporation, which you have 15 years to amortize. So if you don't
15,
have all the cash up front,
yeah.
I mean, the largest terminal funding deduction that we've seen for a client was $2.1 million.
Wow.
So if the medical corporation doesn't have $2.1 million to contribute, it can break it up into 15 increments. And every time it makes money, instead of paying taxes, it's redirecting that money to the pension plan in
Right.
order to give the doctor a salary, a pension.
Right. JP, any other benefits that we haven't touched upon? The one that comes to my mind, you know, at least during the accumulation stage, I don't know if we brushed upon that, is the deduction of management fees.
No, we didn't mention it yet. That's the seventh
All right.
deduction.
Go for it.
So again, something that's not permitted to RRSP savers. You're not allowed to write off the investment management fees that you're paying to your money manager to look after your RRSPs. In the context of a pension plan, those same fees are tax deductible to the corporation, whether it's a medical corporation or a normal corporation. Doesn't matter. So in effect, what we're doing is we're reducing the cost of investing.
And JP, this is huge. I know we left it to the end, and I hope everybody kind of stayed on to listen to this part. But this is really big because, and I'll tell you why. A lot of people are, you know, upset that the government, and rightfully so, that the government doesn't allow the deduction of management fees in registered accounts. Okay, but we're not here to argue about government policy because we're not going to go anywhere. But the fact of the matter is, the larger that portfolio, 1 million, 2 million, 5 million, whatever it may be, that's a huge tax advantage for anybody who is implementing the PPP. I mean, imagine a portfolio of just simple math. You have a $1 million portfolio that was in an RRSP. And the advisor is charging you 1%. Again, for easy math. That $10,000 is non-deductible. You snap your fingers, you make that $1 million a PPP. Or you convert, you're at a stage where, yes, I want to do my PPP. The RRSP is now part of the PPP, and the advisory fee is tax deductible. So now you can deduct that $10,000 fee that the advisor is charging you every single year. This is a huge benefit because it's a benefit that you do not have and you probably will never have during an RRSP or a RIF. So if you are holding an RRSP account, which is then converted to a RIF account for 30, 40, 50 years, 60 years, 70 years, and you're never able to deduct the management fee versus deducting the management fee, this could be tens of thousands, hundreds of thousands of dollars of wealth in the form of tax credits because of the deductibility. Am I missing something here, JP?
No, that's exactly what it is. It's the way I look at it is that dollar goes further because it costs less because you're able to claim a tax deduction.
Now, here's an off question, and I don't know if you know how to answer it, and then I don't know if there's any other benefits, but we'll wrap up. Can in a traditional account, the client could pay the management fees from the bank account of the corporation or from the bank account of the individual? Is there any issue with that here?
No, I mean, if in fact that's even better.
Right, meaning that the portfolio doesn't necessarily need to pay for the management fee.
No, it could be paid straight out of the corporate bank account.
Perfect, excellent. So there's no like strings attached when it comes to deducting the management fee.
No, because the pension plan legislation and the pension plan text that governs this arrangement specifies that it is a responsibility of the corporation to pay for the investment management fees.
Perfect. JP, anything else on this topic before we wrap it up?
There's lots more, but let's wrap it up for now. And we'll see you in the next segment.
Absolutely, guys. Thank you so much for taking the time. If you have any questions, you could reach out to me. It's Michael Martella. Actually, probably the best way to get a hold of me is my cell phone. It's 514-497-7219. You could search me on LinkedIn or on Google or anything like that. It's Michael Martella. And I'll be more than happy to answer any questions you guys have. JP, thanks again. Looking forward to the next segment, my friend. Okay, be well.